All right, Sachin, let's get into this. So you are someone I would say is not only a really strong person in understanding stocks, but you're a historian of the stock market, which is why you've been able to kind of do well in the market. So I guess the first question I have for you is, from your perspective, how did this happen, and how can a company like Silicon Valley Bank be down 92%? How is it possible for a stock to just collapse like this and investors to lose all faith in the company itself?
I think we need to roll back like 2-3 years, especially with the boom of like the venture capital and private equity. The challenge was that the bank has got a lot of money, a lot of investments were coming in. Okay, and the banks were under pressure to generate the yields. And I think this is where all the MBS that the SVB has bought, especially like the one which is hold to maturity, that is coming. So the problem what has happened is that they had a lot of assets which is not liquid. Okay, that has created the panic situation. The another challenge is that as market is being dried up, I think everybody is looking for cash, so there has been withdrawals.
Let me ask you one quick question. Why were they
Yeah.
buying mortgage-backed securities? Why weren't they just buying stocks? Like, why didn't they just put all that money into public equities or even startups? Why MBS? Why was that the best asset they wanted?
See, internally how they do it, it's complicated, but banks has to work within a given framework. Okay, having said that, like within that given framework, like what they can do, where they can invest, the challenge comes is that they still have to do some financial engineering within that. I think in this particular case, the MBS were sold to them. Okay, and a lot of things happen on a relationship basis. Okay, they clearly underestimated the risk of hold to maturity. They also underestimated the risk of liquidity going forward. I think the challenge, see, they have good assets. I mean, I will not say that the bank is completely screwed in a way. I think their challenge at this point is liquidity. Okay, and in this market it is very difficult to raise capital, because if you raise capital, that capital will immediately be used by people to withdraw. So basically capital coming to bank is very difficult. So what I expect at this particular point, if there is no bailout, that it's very unlikely that the stock will be continue trading for this week or next week. Okay, it will be halted.
Really? You think it's going to be halted for the next week?
There is a chance, because if you see their book value, my understanding is that the current market cap is below their book value. So at this particular point, it is a fair thing to find that how good the book value is. Okay, if the book value is reasonable, okay, a lot of people who masters distress investing like Bill Ackman and all, they would try to jump in, maybe Warren Buffett, but these people will only jump in when they know from their insiders that there is a deal in place and there is somebody going to bail it out. Okay, another scenario is that someone comes in and completely acquire the bank and the book and everything. Okay, there are a lot of reasons to do that also. First is that it could be also a fintech at times. I mean, right now fintechs are struggling for cash by themselves, so I hope they will not come at this time, because it allows you to have a banking license. So there are several industries which wants banking license. Okay, if you take the case of India, like in Bharat Pay, they were the only fintech to get the banking license for a very simple reason, because they acquired a bank in distress.
Right.
So there are a lot of people who would be interested in banking license. Okay, they could come and take it, but they need to raise the money for that. Okay, if the stock is being allowed to trade at this particular point, it will keep collapsing until and unless there is a statement made from government or Feds or someone about it, because company has made it very clear that they have failed to raise the capital.
Okay, so now here's my question. Why do you think they have failed to raise the capital? Why aren't, like, if I'm a VC fund like Sequoia and Andreessen Horowitz, this bank, I think people don't realize, has been fundamental in the startup community because of the types of loans they give, the types of deals they make with founders. Like, you know, my startup works with Bank of America, but we don't get anything special from them. Silicon Valley gives things that are very special to founders. So why wouldn't a VC fund try to save the bank, potentially buy out the bank, and then, you know, have all the assets? Because eventually, you know, if the startup community survives in the next decade, the bank theoretically should survive.
So there are three reasons for that, Amit. First is that VC banks don't have mandate to buy assets in distress. Their mandate is to invest in early stage, high risk. Okay. The second is that if you inject money or capital in the bank, there is no guarantee that that capital will not be withdrawn, because currently it is, when you have panic about a bank, you don't care about anything, you just want your money out. I mean, why would you keep your money in Silicon Valley Bank if you could move it to JP Morgan or Merrill Lynch? That's
Right.
the simple question. Okay, nobody takes risk on the bank. You can go and take all kind of risk in finance, but bank is something you never take risk on. The third part is that the venture funds and financial institutions are already in trouble for last 2-3 years in this scenario, that they have already lost a lot of money. Okay, the question is, when the deals are cheap in market, you put capital, what's your mandate is, why you go and buy a bank. So the way these things are normally done is that normally a consortium of people and companies come together. Okay, like we saw in the case of long-term capital management in 1998. Okay, at that particular time in long-term capital management, actually there were only two banks that decided not to participate. That was Bear Stearns and Lehman Brothers. Okay, it was, and by coincidence or by design, these were the two banks that were allowed to go underwater. Okay, so it's a very cult kind of a culture. So if people will come together, everyone will come, and unless no one will come.
Okay, so another question for you. I was talking to our good friend Chris Patel last night. He called me and I was talking to him, and he said JP Morgan, Goldman, they are all probably acting like vultures right now, and they are getting ready to attack and potentially buy out.
I agree with Chris on that. I mean, see, there are no emotions in this business. You have to be ruthless. Okay, we saw what happens between Binance and FTX. I mean, FTX was doomed, but Binance has showed that it dooms very fast and in a very bad way. Okay, so if there is, and again, I mean, these MBS that they are holding, somebody has sold them. Okay, and if they are not able to liquidate, that means there is a counterparty on the other side as well. Okay, the counterparty can go and say, okay, I can give you 60 cents on a dollar. But that kind of offer hasn't come yet.
Now, I want to ask this question. Why were interest rates being high the reason they had to sell the mortgage-backed securities and take the $2.5 billion loss? Like, what is the correlation between that?
I think the correlation is actually, as much I understand, is, see, normally what happens is that you will have the relationship between bond and equity. That means if equity is not doing well, bond will generally do well.
Yeah.
In this particular case, you can have risk-free returns from treasuries, so bond is also beaten. So anyone who has money in bond, I mean, it's already on a relative disadvantage relative to treasury. So at the end of the day, they have a lot of these structured instruments and bonds on their balance sheet which are not doing well. I think it's a critical risk.
Okay, so if you are, I guess, an executive at Silicon Valley Bank, and you're seeing Jerome Powell basically say from probably 8 months ago that inflation's bad and we're going to maintain rates, and you start to believe him, and you have some pull in the company, do you start to say to the other executives, hey, this might get bad for us. Why aren't we doing, like, is this corporate mismanagement? Is this Enron? Is this Lehman? What exactly is, or is this a fluke that just happened and that's it? What would you compare?
See, I mean, it's actually, it's neither of them. I mean, I don't know how would I have behaved if I would have worked for bank. I probably would have behaved like the herd the banks does. I mean, I wouldn't be any different. The challenge is that you need to understand how people deploy fiduciary duty. The first thing they ask is what everybody else is doing.
Yep.
Okay. Another thing is, if something has worked for you, you need to have a very strong reason to move away from that. That means you need to be proactive. These people are not from that category. So most of the time, by the time they act, it's already too late. Okay, so even if somebody goes them and explain a scenario that this could happen, probably they wouldn't have done anything. They said, nah, I don't think it's happening. Okay, like, I mean, look at us. Like, if you go back to 2021 and somebody tells you that Palantir is going to under $6 or Tesla is going to $100, I mean, how many of us would believe on that? And how many of us would act on that?
Right.
Okay, so even with the hindsight, we can say a lot of things could have been done, but I doubt. My worry is that if they are under this kind of a stress, there are probably few other banks of regional nature under the same issue.
Okay, now I had a tweet this morning, and I want to break this down. Is this the catalyst that that is similar to what happened in 2008? I know you said it's not exactly
No,
like
it's
Lehman,
not.
but
No, it's
is
not.
this something that could crack the market and we get S&P to 3,000? Like,
See, in 2007, the biggest problem was that people have no clue what their counterparty risk was. So there was a lot of distrust.
what do you
That
mean by
means JP
counterparty risk?
Morgan didn't know what is the risk Goldman Sachs is carrying on their books.
Right.
Okay, so there was the problem that time was the counterparty risk. The counterparty, that's why that particular time the liquidity dried up. When we call about financial, I mean, there was a literal collapse of financial system. People were not trading with each other. Everybody was holding their musical chair, and that's where the issue was happening. If anyone is exposed, they are gone. So that's not the case at this particular point. That's one. The second is that was also, but it doesn't mean that the overall economic crisis cannot be bigger than GFC. I mean, you can never say never. Okay,
Yeah.
you have things happening in the crypto market. Okay, you have things happening. You saw that even the EV boom and a lot of other companies are struggling. Okay, we know that the interest rate are still going to go high. The unemployment has to go down further. And to be fair, I mean, I have never seen the bunch of clown that are sitting in Congress in my life in both parties. I mean, not Dems or I mean, so at this particular point, there are, I mean, almost several catalysts are present that can trigger a larger crisis. Okay, there's geopolitical issues that is going on that has not been handled. There's election on the line. Okay, I mean, the cultural war in US has gone out of proportion. There are a lot of things that are on table. So you can say there's a lot of gunpowder, and you don't know what will spark that. But I doubt this is the spark.
So you ultimately think this is just something that happened. It's unfortunate, but it's not this underlying catalyst within the infrastructure of the economy that destroys everything the way it is right now. There's other things that could do that.
See, one of the problem that banks have done is, see, generally in a high interest rate environments, banks should be able to make easy money. But since banks have not seen interest rates for a long time, I think their exposure to overall treasury is not that high.
Right.
And that is why I mean, ideally, like if you can lend money at a high interest rate, I mean, you should be doing well.
Right.
So that is the challenge I think banks are facing at this particular point. And my understanding is like the big banks like JP Morgan and Goldman Sachs. I mean, these are like vultures. They'll go and they will find whatever easy money they can get in the market.
This is interesting. I think no one expected this random collapse to kind of happen yesterday of one of these biggest banks. It also to me, it was just like, well, you know, this is kind of the VCs created this problem as much as it sucks, right? Because they overfunded startups at such a high level, obviously FTX, Sequoia, all this stuff. And when founders raise this much money, they need to do something with it. And if they're going to get really nice interest rates or loans from Silicon Valley Bank, they're going to give it to them. And then if the bank, you know, has way too much money, they have a fiduciary duty to do things like buy mortgage-backed securities. But in a bad interest rate environment, that stuff might fail.
See, I mean, in theory, it all works, but in practice, it doesn't. I mean, practice, it's a very greedy situation. Okay, and the only time you know about it when you are in a crisis like this. I think there has been quite a fall in the market. Palantir is at 7.37.
Yeah, I was just about to ask you about that. I don't think you'll be on the weekly tonight because I know you're busy. But what are your thoughts quickly on Palantir and some of the price movement we've seen over the past couple of days?
See, I think we have discussed this before that, I mean, at this level is definitely cheap. There is no doubt about that. And we also saw and we discussed like, I think when it went to the levels of 10.3 and all that it can go with a macro news up to that level, but in these macro, it's very difficult to hold. So my understanding is still that we will be bouncing between the range of 7 to 10 for long time. And of course, there will be sometime peaks above 10 and sometime troughs below 7. Okay, so my strategy is very simple. I mean, I'm just trying to play as many options as possible. I do covered calls. I do a lot of cash secured puts. I mean, I'm already short a lot of contracts yesterday. Actually, my timing was pretty bad. I just shorted before the collapse. I thought, okay, it looks like, but I mean, it's okay. I mean, most of my strike price is at 7 and 7.5. So I just have to sit it around for 10, 15 days.
Got it. All right. Thank you so much, Sachin. Means a lot for you coming on in short notice and breaking this all down for us. Super awesome. I have his Twitter linked in the chat, so everyone, please give him a follow on Twitter. Lots of great financial news, and you guys can check him out there.